Thank you. My technology is still set up as always. Okay. I'm changing my layout. You're getting the first change in layout that I've used for a lecture for quite some time, because you may have noticed I'm going for crowdfunding. Unless they're talking a bit about that at the end of the presentation. But the main thing I'm talking about today is the topic of this book here. How loud is this place? It sounds deafening to me. Yeah, can anybody reduce the volume somewhat? Thank you. Yeah. I don't really need a microphone, I suppose. That better? That better?
Not better.
Not quite overwhelming? Okay, good. All right. So the main thing I'm talking about today is the topic of my new book, Can We Avoid Another Financial Crisis? I thought I'd bring it straight home. You had one back in 2008. What caused it? If you ask your professional economist, he'll tell you it's exogenous shock. And of course, there's no way that private debt or credit played any role in that, because they know from first principles you don't need to worry about them. So here's Ben Bernanke in a book called Essays on the Great Depression, which was really effectively his application for the job as Federal Reserve President, Federal Reserve Chairman, collecting papers he wrote before 2000, back in the year 2000, and in discussing Irving Fisher's theory of the Great Depression, he basically rejected Fisher's logic. He rephrased it in a fairly neoclassical way, but he rejected the basic logic on this argument that debt deflation was no more than a redistribution from one group, debtors, to another group, creditors, and absent implausibly large differences in marginal propensities to spend between the two groups, pure redistributions should have no significant macroeconomic effects. Now, he spent another couple of pages talking about Fisher, but you've all heard of the name Hyman Minsky? He spent 48 words on Hyman Minsky. Okay, that was it. But he gave slightly more attention to Fisher. Now, Paul Krugman, talking about Richard Koo, who like me, has a credit-based theory of where financial crises come from. He rejects Koo's logic on the basis that Koo's talking about the entire economy being balance sheet constrained rather than particular groups being balance sheet constrained. He said that makes no sense, typical Krugman way of stating things. Whether that is there must be creditors, so there have to be some people who can respond to lower real interest rates even in a balance sheet recession. In other words, if you imagine what they're envisaging the credit system like, it's like a seesaw. If one half is up, the other half has to be down. Okay, and it's just which one is high or low depends upon interest rates being low or high. But overall, there's no overall effect. Well, that means that that's really useful, okay, because it means there's a whole lot of data you don't have to bother looking at. Okay, for example, you don't bother looking at this data. The red line is the ratio of private debt to GDP in Denmark since 1968, which was 100% of GDP. It peaked at 260%. Which is actually, in terms of significant economies, it's virtually a world record. Congratulations. And the blue line is credit, which is graphed on the same axis, but you can just see a slight, whoops, the wrong button there. Oh, there we go. You can see the slight little red dotted line here. That's zero. So here, for example, that means that credit was equivalent to 20% of GDP back in 1987 or thereabouts. It dipped to below zero in the mid-90s. And then it peaked over here, which was 2007, 2008, at about 20% of GDP. Then it's plunged down here, and you've been bouncing around negative and positive credit ever since then. But that doesn't matter, that's irrelevant. We've got the advice of leading economists, one with the Nobel Prize, the other running the Federal Reserve. They must know what they're talking about, mustn't they? Yeah. Also means we can ignore this data. This is the correlation of credit with unemployment. So that's now the blue line that I had in the previous graph, but now of course on a larger scale. That's credit peaking at 20, so the red line is credit, the blue line is unemployment. As credit was peaked at about 26% of GDP back in 1987, and it plunged to negative 3%. And then before the financial crisis hit, it was up to about 30% of GDP. And the fact that one looks like the opposite of the other is irrelevant. You know, we know on a priori grounds it can't possibly matter, so let's ignore that too. And then if you look at the change in credit and the change in unemployment, well, you can ignore that as well. You know, the fact that unemployment really rises rapidly when credit falls is just a coincidence, really. Forget about it. Don't tell anybody. Okay? And you can also say that, well, it should be more obvious here that clearly there's no relationship between the level of mortgage debt, this is actually household debt, which you do hold the world record. Okay? Congratulations. In 2010, in terms of the level of household debt, on the planet, you have the world record 140%. But don't worry, Australia's trying to catch up. So people like my country will take over sometime in the next couple of years. So that's world record, and been going down since then. And no obvious relationship. So there's no point drilling any deeper, for example, and looking at the change in household credit and the change in house prices. Unfortunately, this is a very short time series, it only goes back to 2004, but the 0.4 regression coefficient there, ignore it, doesn't matter at all. Well, let's get real. It's the economists who can't understand credit. The fact that they can't understand it is no reason not to take it seriously. It just means they're lazy. And frankly, I've had enough of them. I'm sick and tired of having to kowtow to these twerps. If they don't actually go out and look at the data like this, then it's now mendacious to not look at it. We're talking 10 years after the financial crisis, about bloody time they looked at data that contradicts their presuppositions. And if they want to say that it doesn't matter, they've got to give a damn good explanation as to why. Now, Krugman, in having a bit of a battle with me back in 2012, came out and said that, talking about how banks actually operate, he said, first of all, any individual bank does in fact have to lend out the money it receives in deposits. Totally, it's obvious, experts know this. This is the Bank of England 2 years later. Rather than banks receiving deposits when households save and then lending them out, bank lending creates deposits. That's a direct contradiction of Krugman. And when that paper came out, basically I knew the authors as it happens. And I said, hallelujah, thank you very much for publishing that, because rather than having to quote people who live in the undergrowth of economics, not just Minsky, but people you wouldn't have heard of, most likely another good friend of mine, Basil Moore, who developed the whole idea of endogenous money back in the 60s and 70s. Rather than having to quote Basil or Minsky, or refer to work by obscure research directors in the past like Alan Holmes, I can quote the Bank of England. That's great. Now, of course, Krugman quotes them too and then says, colour me puzzled, I can't understand why this makes any difference. Why should it matter, It's no different. Banks, they're more complicated, than we teach the students in Economics 101, but that doesn't mean they've got any unlimited ability to create money, or that they're somehow outside the usual rules of economics. Don't let monetary realism slide into monetary mysticism. That's a witch doctor telling you not to worry about the fish chicken entrails. Okay? Even the Bundesbank has come out last week. Now, I'm actually cock-a-hoop with this, because quoting the Bank of England is fantastic. I can now say, look, forget about what Krugman says, he's factually wrong, here's the Bank of England. I never thought I'd say, forget about Krugman, he's factually wrong, here's the Bundesbank. Okay? Just what a radical shift that is for the Bundesbank coming out and saying, this refutes a popular misconception. It's a popular misconception amongst mainstream economists who are supposed to be the experts on this stuff. Okay? The public, generally speaking, tends to feel this might be the case. The Bundesbank is telling the public they're right and the so-called experts are wrong. This refutes a popular misconception that banks act simply as intermediaries at the time of lending, that banks only grant credit using funds placed with them previously as deposits by other customers. They also trash the money multiplier model as well, which is still in the textbooks. So Krugman is asserting this. Any individual bank does in fact have to lend money it receives in deposits. That is actually, under using modern vernacular, that's an alternative fact. Okay? He might as well be working for Trump as opposed to working against him. About time it's spelling that out. So what his model, he calls it loanable funds. That's the traditional model of it. And they talk about these things as being simplifying assumptions. And you would have copped all this stuff when you reject or criticise something you're told, oh, no, it's just a simplifying assumption. That is not a simplifying assumption. That is a categorically false assumption. Categorically false. And the economics is replete with assumptions that are false. They're not just necessarily simplifying something, they're saying the opposite of what actually exists in the real world. And this is one of the most classic instances. Now you can defend that. You can defend making an assumption which is categorically false if it obeys what Einstein once coined as the KISS principle. Keep it simple, stupid. Keep it as simple as possible, but no simpler. I summarise stupid as no simpler. Okay? The KISS principle. Keep it simple. As simple as possible, but no simpler. And that was the way Einstein put it. So the bad news, you don't use a complicated model, a simpler one works just as well. So the question is, does loanable funds, which pretends that banks are just intermediaries and ignores the fact that they originate loans, is that a simplifying assumption that has the same impact, gives you the same sort of model as if you say, well, banks actually originate, they're not intermediaries? Does changing one or the other make a significant difference? Well, let's take a look. I'm going to compare three situations now. One, a little toy model of the economy where there's no lending or borrowing. The second, the same toy model, but now I allow loanable funds, which means one agent who's not a bank lends to another agent who's not a bank. And it's a simplifying assumption, by the way. I'm leaving out the bank charging a fee here. And that is a simplifying assumption. It does make no difference in terms of the qualitative behaviour of the model. We'll leave that out. And the third one is endogenous money, which is the term which has been used for the last 40 years, really to differentiate the vision that the post-Keynesian economists have from the neoclassicals, where the neoclassicals treat money as exogenous, outside the economy. That's why this is on the ISLM model here. Anybody done the ISLM in their classes? Okay, you get a vertical straight line for the money supply, which means it's exogenous. Okay, the government's supposed to be able to move it backwards or forwards, or side, left or right on the graph. That's what's meant by exogenous. So this approach became known as endogenous money because it was in contrast to exogenous money, which was the principle of the ISLM model. So here's a three-person economy. I'm calling Tom, Dick, Harrier. I don't know whether this phrase is still used amongst young people these days. I'm showing my age now, but the expression used to be in English. Any old Tom, Dick and Harry can understand that. Okay, Tom, Dick and Harry. So I thought I'd form a three-part economy, Tom, Dick, Harrier. And so each of Tom and Dick and Harry has $100 in cash, and they each turn over their accounts twice a year. So with $100, they spend $200 per year. And that's, by the way, a very important distinction. Economists tend to be very bad at differences between stocks and flows per year. So the stock of money they've each got is $100. The flow, in terms of the health and that money turns over, is $200 per year, and they spend it equally on each other. And I've got no borrowing or lending as possible, so the total expenditure in that economy is $600 per year on the basis of $300 as the money supply. Okay? So you draw this up, and what I've now got is a matrix where this is expenditure by Tom, that's for his spending, $200, so his account goes down by 200, and 100 turns up in Dick's and 100 in Harry per year. That's the annual turnover of money. Similar for Dick, similar for Harry. Now, when you work out what's expenditure and what's income on that table, then the diagonal, the negative sum of the diagonal, is aggregate expenditure. And as you can see, it's absolutely essential that aggregate income is aggregate expenditure. The money you spend becomes somebody else's income. So the off diagonals, if you add them up, are also identical to the negative of the diagonal itself. And the rows necessarily sum to zero. If you don't show a zero sum here, you've made a mistake. And that's the advantage of laying it out this way. Okay? It must be the case that the rows sum to zero. Now, each individual column can be positive or negative. If there was a difference between the two, then that would be the amount of savings that particular agent made each year. So the columns don't necessarily sum to zero. Each column is the net savings, but the aggregate is zero, as you can see, overall. You can't save money into existence. There's $300 in this economy, that's it. No more can be saved into existence. One individual can save more of that money than the other, but you can't create money by saving it, which is a very important point I'll get to later. So that's the first one. Now, Act 2 is where you let one of them borrow money from the other. So what I'm going to have here is Tom borrows $10 from Dick to spend on Harry and pays 10% interest. And then Dick finances that loan by spending less money on Tom and Dick. It's on Tom and Harry that's supposed to be. I always make at least one mistake in sending out a lecture. I'll fix it up. It'll be okay for Ecuador next week. So total expenditure is now $601 per year. It's gone up by $1. And the logic here is I'm now putting in the changes that are occurring here. So there's the there's $10 that Dick was spending on Tom and Harry, and he's now lending to Tom instead. Tom then spends the $10 on Harry, and he pays $1 interest to Dick. Okay? Now, if you add up the diagonals, or you add up the off diagonals, you get the same at 601. The $10, as you can see, the $10 in credit cancels out. Now, this is the neoclassical vision of lending. Okay? For one agent to lend to another, there has to be a part of a flow of loans. What used to be a flow of expenditure has to become a flow of loans instead. And then the loans are then spent by the person who's borrowing. So only if you had a big difference in how much Tom tended to spend versus Dick would you be any macroeconomic impact from that. One cancels the other out. I'm showing that they're identical, so there's no change, just for the sake of illustration. So that $10 of credit, it's not created, it's credit. There's no creation of money going on here. That $10 is cancelled out at the aggregate level. Rather than Dick spending it, Tom's now spending it. Now this one, the $1 turns up, that's interest for Dick, expenditure for Tom and income for Dick. I thought I had more on that slide there. Actually, I must have changed those slides. I've had a few little illustrations turning up. But that extra $1 is added. So gross financial transactions are part of gross expenditure and gross income when you include lending, even in loanable funds. And I don't know whether neoclassicals realise that or not. I wouldn't be amazed if they didn't. Now, the third act, I'm now renaming endogenous money. Because I think endogenous money, you have to be an insider to know whether it even matters. Okay? I'm calling it BOMD, Bank Originated Money and Debt. That says a bit more, I think. So our economies have been bombed. Let's see what that means. So Tom now takes a loan of $10. I'm not showing it in this table, but I can show it in a simulation later. $10 from the bank. Pays 10% interest, exactly the same situation as I had between Tom and Dick beforehand. Now total expenditure is now $612 per year. It's gone up over the other situation. If you look at what's going on, the $10 is additional money that's been created by the loan, which is then spent by Tom on Harry. So it increases, there's an increase in the assets and the liabilities of the banking sector. They remain balanced, of course. But that enables $10 to be spent by Tom on Harry without reducing any spending by anybody else of the economy. So it's a fundamentally different world for that to happen. And then what I've got happening is the bank, of course, now gets that income. So I've included the bank in my rows and columns as well. And then just for simplicity, I've got the bank spending that $1 interest income equally on Dick and Harry. So that generates another $1 of expenditure. So the two situations are fundamentally different. That's a numerical illustration of the difference between them. But logically, it goes much, much more further beyond that. And I want to show you just in logical terms now, looking in symbols instead. If you look at the world where there's no debt at all, that's Milton Friedman's velocity of money monetarism. And now I've got A and B, C, D, E, and F representing those flows, and of course I can change to any other value I like. Exactly the same logic follows. The sum of the matrix is obviously zero. That's why we talk in terms of gross rather than net, because net is zero in monetary terms, in a monetary system. But the negative of the diagonal is aggregate expenditure. The sum of the off diagonal is aggregate income. They're necessarily identical with each other. You take the negative of that, the trace of that matrix, and if you say the sum of A plus B plus C plus D plus E plus F is the velocity of money times its turnover, that's Milton Friedman. Okay? And that's where aggregate demand and aggregate income are equal to the velocity of circulation of money times the amount of money in existence. Now, loanable funds takes that and adds gross monetary transactions. Now what I've got instead is that the agent, this is Dick, lending to Tom, so that's L dollars here, led over here, and then interest paid by Tom to Dick, that's the interest payment. You do your summing, do the same substitution, and you now find the additional bit is the interest payment, which again I don't think neoclassicals are necessarily aware of. They use this model to not have to think about money. Okay? They don't use it to think about money. They use it as an excuse not to think about money. to drop money out of their models. So I doubt that they've even realised this particular consequence of taking it into account. So that's Paul Krugman's world. Now what about the real world, endogenous money? Same basic logic. That's now, the loan is now a flow of new loans coming from the assets and liabilities of the banking sector. I'm not showing their assets here, I'm not showing their liabilities. I could make the table larger, but that would just be adding that extra detail on the other side. So now you take the negative of the trace of that matrix and you substitute, well, let's define L as the rate of change of debt. Okay? There's L as the rate of change of debt. Do the substitution. And you now find there's Milton Friedman plus what comes out of even loanable funds, interest payments, plus credit. Now, if you're leaving credit out, you're not analysing capitalism. So you're all learning in your economics degrees, you're learning a theory of capitalism isn't actually about capitalism. No wonder they didn't see the financial crisis coming. We're in the real world, and credit is part of aggregate income and aggregate expenditure. It's also part of aggregate capital gains, which is yet another element I don't quite go into in this particular presentation in great detail. I cover a bit of it. But credit matters vitally to macroeconomics. And the reason they didn't see the crisis coming is they ignored what caused it. Not that it was an exogenous shock. They simply ignore, by a set of false a priori assumptions, they ignore what actually causes financial crises. So expenditure is income and change expenditure is turnover of existing money plus new credit, which is created one for one with new debt, new credit-based money. That's total expenditure. Now, you can roughly measure this, not exactly. We do not measure the turnover of existing money. We could actually do that now with modern technology and point-of-sale, FPOS systems and so on. You could actually tell if somebody using a credit card or cash or a savings account to buy something. You could work out, we know corporate debt figures fairly accurately, so we could actually quite easily now measure turnover of existing money. It's something I hope happens with statisticians in the next 20 or 30 years if we win this argument and get economics out of its fantasy, pull its head out of its backside and get it to look at the real world. Maybe statisticians will then respond and will actually measure this stuff. But what you get is not pure redistributions, it's expansions and contractions. So rather than the seesaw, you've got an elevator. Okay? It's a vastly different world to look at it this way. And what I call the smoking gun of credit is a graph I drew up for this particular book, where I add GDP to credit together. Now I know there's double counting going on there. A bit of credit is used to buy goods and services, but generally speaking, 85% of it or more is spent to buy assets. So we don't even count that in GDP. But it's a fundamental part of monetary expenditure. So when I do that graph, the red line on this graph is the GDP of America. The blue line is GDP plus credit. Bit of double counting there. The black line is just taking credit and dividing it by GDP, and it's graphed across on the left-hand axis. Now you can see I'm starting this graph in 1968 or thereabouts, but I could take it right back to 1945, and all the way through you'll find credit was positive. Credit was never negative. It got very close to negative in 1990. This is the only time it's been negative since the Great Depression. And this phenomenon is what Fisher was trying to identify, that Bernanke didn't bother checking because he believed debt is a pure redistribution. Notice that the peak of the blue line is when the global financial crisis began. Credit is by far the most volatile part of expenditure. And now, given how huge the level of private debt has got to be, courtesy of ignoring it in economic theory for the last, forever, really, but it's certainly since Irving Fisher, ignoring it, we've let it get to a level where it now not just dominates but crushes our economies. And capitalism's slump now is due to letting that debt level get too high. Now let's take a look at the no significant macroeconomic impacts. This is a great chart for America of the unemployment rate versus credit. Anybody here do psychology? Anybody seen a Rorschach plot? It looks like one, doesn't it? They're two completely different series, and they're trying to tell me they're not related to each other. That's why I say it's mendacious. You have to be turning a deliberate blind eye to the data not to see this stuff. I'm sick of them getting away with it. I want your help in stopping them. Now, what about housing markets? Well, this is the correlation of change in house prices to change in household credit. I could make it more extreme by that by just taking out the mortgage data. I happen to have mortgage data for America and Australia and to some extent the UK, but not for the rest of the world. The Bank of International Settlements, by the way, deserves great credit for putting this data series together. I could not have done the book without them producing this data series, which shows commonly defined terms for debt and credit, government and private sector, broken down into non-financial sector debt and household debt. I couldn't have done the book without them. I just hope they also carry on with the excellent work they've done there to bring out a mortgage series as well, which will make my work even easier to illustrate. But the Bank of International Settlements deserves great credit for having done this. By the way, the Bank of International Settlements had as its research director a guy called Bill White, and Bill was probably the only person in official position who not only had read Minsky but understood him before the crisis hit and was warning of the crisis before it occurred. So the Bank of International Settlements is the only international institution that can hold its head high in the post-crisis period for having warned about the crisis before it happened. That's the housing market. What about Denmark? Here's your smoking gun. Rather more complex mess than the American situation, but the same sort of basic story. Your crisis began roughly at the time of the global financial crisis. Credit peaked. You've gone from positive credit to negative credit now. You're bouncing between the two, generally trending down. That's why your economy's in a funk. Okay. Thank God you have a trade surplus, which makes a fairly substantial difference, particularly over here. Credit and unemployment in Denmark. It's more clear, it's clearer in the America case because America is the world's biggest, almost self-contained economy. That's why I prefer to use the American data, because you don't have other issues about valuation of the currency, trade surpluses, etc., getting in the way, or the fact that the economy might be a more specialised economy. It's the most diversified economy in the world. House prices in Denmark. Again, I'd like to have a longer time series. Again, the same basic dimension. This is all the stuff that's being ignored by the mainstream. So, finally, a decade after the crisis, some leading neoclassicals are starting to admit there's something wrong. Now, the trouble is most neoclassicals are wedded to their methodology the same way that a priest is wedded to the church. Okay? It's an existential crisis to admit there's no God. Well, you think there might not be a God. You don't say that in your Sunday sermons. Okay? So you continue preaching the same stuff, and most of them believe it, as you know from your own lecturers. But there are some prominent neoclassicals who are saying, hey, there's something wrong here, and seriously wrong. So one of the first was a guy called, I love his name, a beautiful alliteration, Narayana Koshalakota. Fantastic name. He was the Federal Reserve Chairman for the Minneapolis Fed. There's 13 district Federal Reserves, and he was the chairman of the Minneapolis. Now that's right in the heart of what Krugman calls freshwater territory, where they are extreme believers in the neoclassical vision, where even the unemployment during the Great Depression was supposed to be voluntary. Okay? That extreme. But he was the first one to say there's something seriously wrong with the data. Not the data, our model. Because we've had a decade now where the model's been seriously wrong. He said, looking at it, looking how we do economics, the starting premise was that there's a well-established model of macro theory on which we should build our models of the real world. And he said, after the highly surprising nature of the data over the past 10 years, this premise is wrong. We simply do not have a settled, successful theory of the macroeconomy. Now, if any of your lecturers come back at you and say you just don't know the literature well enough, quote Koshalakota. Ask when they were last chair of the Federal Reserve District. Okay? There are some seriously influential people now who are realising the theory has to be abandoned. Olivier Blanchard. Olivier was a major champion of DSGE models. He and I've ended up corresponding recently and getting on rather well. And he came out and said about DSG models, they are based on unappealing assumptions, not merely simplifying, but ones that are profoundly at odds with what we know about consumers and firms. Okay. Not simplifying assumptions. You can't be told as a first-year student, don't worry, in later years we'll take these assumptions away. No, they don't. They make them worse. Paul Roman, probably the most outrageous example of this, saying in a paper called The Trouble with Macroeconomics, which is the takeoff of an article about string theory in physics, For more than 3 decades, macroeconomics has gone backwards. Models attribute fluctuations in aggregate variables to imaginary causal forces. He actually nicknames them things like trolls and gremlins. And he said, I really highly recommend reading that paper. And then so people will say, oh, well, you know, Milton said that the more significant the theory, the more unrealistic the assumptions. Now he notes here there's no authority on which Friedman had made that statement. Okay? He wasn't basing himself on any literature. He made that line up, okay, as a way of evading criticism. Actually, he made the line up to stop people reading papers in the American Economic Review talking about how what the shape of firms' actual cost curves are. If you read the paper, you'll find he was trying to prevent people reading empirical data on the shape of cost curves in firms which contradicted economics textbooks. That's why he wrote the paper. It's always worth reading the originals, even the originals of these guys. And he said, more recently, all models have false as the hand waving. He said there's a non-committal relationship in economic modelling between the theory and the reality. He said it goes so far beyond postmodern irony that it deserves its own label. He describes them as post-real. Okay? So if you feel at all uncomfortable about what you're being taught, you've got good company, okay, from within the profession. People who far outrank the lecturers you've got here who might be teaching this stuff as gospel. Now that raises an issue, of course. What do you do? What's the next step? Now Olivier Blanchard, and I've had a bit of a debate with him over this point, but he's still used to working so much in the neoclassical tradition where I can't convince him. Maybe one of these days I will have to wait and see. But he said starting from explicit micro is clearly essential. You've got to start from micro to build macro. And he says, where else to start from? You can't do ad hoc, and I agree with that. You can't be ad hoc. You have to have some sort of guiding principles by which you derive your models. Otherwise, there's a model for everything. And that's really the state of neoclassical theory right now. Whenever I object to this stuff, I get told, oh, so-and-so's done that in some model somewhere. As if having a billion different models for a billion different circumstances means you can therefore answer any problem. No, it means you're evading every problem. Okay? It's methodologically weak to have that diversity, not methodologically strong. So he's correct in that sense that you need some sort of starting point. And then he says you've got to start from a set of distortions to a competitive economy, but he says, where else do you start from? And look, that's not a positive statement. That's not saying we have philosophically derived why you should start from micro. It's saying I can't work out anywhere else to start from. Okay? Now, what he concluded, and this is quite intriguing, I mean, we are corresponding. I do like Olivier. I'm having a good conversation with him offline on Twitter. And he's a good human being, and we tried to resist. This is very important. He resisted the IMF's returns for Greece. He tried to stop them. He was blocked internally, and they went with very, very powerful, destructive policies against his advice, against his warnings. That came out because a memo was leaked, not by him, about a year ago, showing he was trying to stop the terms they imposed on Greece. So it's a great deal of courage to do what he did. But here he says, I believe there's wide agreement on the following 3 propositions. Let us not discuss them further and move on. The first, macro is about general equilibrium. Now, okay, maybe general equilibrium did lead the charge of the Light Brigade and end the First World War. I don't know. There's other generals out there. And the general I want is general dynamics. The whole idea you've got to do it from equilibrium is a 19th century hangover that neoclassical economists are so imbibed in, they don't even realise they're sticking with a hangover rather than a sensible and modelling framework. If you go back and look at the founding fathers of neoclassical economics, there were people like Jevons, Marshall, Volra, and to some extent J.B. Clark, who gave us the marginal productivity theory of income distribution. They really thought that they were doing statics and equilibrium reasoning only because at that time dynamics was just too hard. And they're right. If you look back in the 19th century, you only had pieces of paper. You didn't have a computer to do the work for you, to calculate different trajectories. And this is Jevons saying it would surely be absurd to wait till we can do dynamics when the more easy one is yet so imperfectly within our power. As we're doing equilibrium now, we expect our followers to do dynamics. And that, even though then technically speaking he was wrong in his beliefs about the nature of static reasoning versus dynamic, that's justified back in those days. This is Marshall. Dynamics includes statics, but the statical solution is simpler. It may afford useful preparation and training, which it doesn't, for the more difficult dynamic solution. And it might be the first step towards a partial solution, we might get a more complex dynamical solution, which is beyond our attainment. So they were conscious that they were using a half-baked, inappropriate methodology, but it was somewhere to start from, and let's hope that our successors in the next century move us forward. Now, when you take a look at people like Clark, intriguingly, whenever we have a change of century, you get these, what's going to come in the next century, articles being written. So J.B. Clark, who was one of the leading economists at the time, was asked to write this for the Quarterly Journal of Economics. Notice the date, October 1898. That's, in terms of publishing a journal and getting it around the world, that's pretty close to 1900. Actually, they made 1901 the change of the century, the century back then. But this was what's going to be the future of economic theory. That was the lead article in the lead journal in economics at the time. And notice down the bottom, he says that people seem to think this science will soon be fairly complete, 1898. And he said, I take issue with that. The great coming development, I venture to suggest, is through the statement and solution of dynamic problems. So he really expected the 20th century to when economists started thinking in dynamic terms. Now you can see from Olivia's closing state they've got so locked into thinking equilibrium that they don't realise that was supposed to be transitional methodology. They're stuck with it permanently. They're still using equilibrium as their organising principle. Now, thankfully, the rest of the world isn't as ignorant as economists are about how the world operates. So engineers and management consultants of all people had to work out what actually happens inside factories. And about 70 years ago, they identified what's called system dynamics. And that's modelling a system, like, for example, a factory, to see why does it have cycles. Now, you couldn't, the reason this actually happened was that J. Forrester, who was the person who invented this area, a leading mathematician involved in designing systems for the American military in the Second World War, he was asked by a factory, why have we got these strange cycles in our production? We gear up, we gear down, this huge fluctuation, where do they come from? And he sat down and wrote just a dynamic process that said, well, this, you have a certain set of orders coming in, then there's you tool up the machinery, then there's a production phase, then there's a warehouse and so on. And he explained the cycles were internal. Imagine what had happened if you said, well, let's assume your factory's in equilibrium. What the hell does that mean? It's not. That was the whole point, that the factory wanted to know why. So he built this set of models where you can say, well, here you've got your orders coming in over here, this is the rate of orders, this is supply. Then you adjust the time, you have a time to adjust for the orders. Notice there's a spelling mistake here, indicated orders, Q. That's an old typo preserved in the literature. This is one of the original ways of doing it. Acquisition, that turns up in inventory, you've got to adjust the inventory, you've got a delivery date here, then you ship them out here. This will give you cyclical behaviour. Non-equilibrium, in other words. And that's an essential part of knowing how dynamic systems behave. Now, 60 years ago, roughly, in this case meteorology, a guy called Lorenz discovered what we now call complex systems. The knowledge of them actually goes technically back to 1899, but the first one we ever saw was 1963. And what's become realised there is that, first of all, complex systems, they can be simple. Not a lot of equations, not a lot of terms. Very simple equations can give you very complicated behaviour, which you cannot tell from the statement of each equation themselves. And when you try to work them out, it's more important to get the relationships between the entities right than it is to get the behaviour of each entity correct. So the fetish on behavioural economics isn't particularly important to me. That's saying we've got to get these little winkles in how people behave right. No, it's actually getting the relationships between them that matters. So here's Lorenz's set of equations for describing turbulence in fluids. Now, it might look a bit complicated, not used to mathematics, but there's the x and y displacement of the temperature variation on a pot, on a kettle, on basically a pot sitting on a stove. And it has three variables, x and y location of the water and the temperature gradient on the hot plate. and A, B and C as three constants. That's pretty damn simple. This is how it behaves. Let's bring it up and show you too dynamically. This is simulated in my software package Minsky, which is open source, and I want to see lots of downloads from Denmark today. Okay, so you simulate it and you get complex cyclical behaviour out of a model that's that simple. That will have, so the cycles in that model never repeat. The actual paper to describe this is called aperiodic cycles. Economists think you've got to have exogenous shocks to get behaviour like that. No, you just need to have a complex systems model. So that's where the other sciences have got to. But the equilibrium fetish of economists have kept this stuff out of economics. And it's massively developed elsewhere than economics. It's about damn time we caught up, and that's what I'm trying to help us do in the remaining time I've got on this planet. So I'm going to apply this with a bit of knowledge that I know you don't learn in economics these days. So some of the reading that I've done as part of where my approach to economics comes from involves Kane, Marx, Keynes, Schumpeter, Goodwin and Minsky and lots of others. But I'm just going to take the simple insights now of complex systems and say let's apply this in a completely dynamic framework and take three definitions that are true by definition. What's the employment rate? It's the people with a job divided by the population. Want to dispute that? Good. Start from something nobody can argue with. Wages share of GDP. Divide the wage bill by of GDP. Debt to GDP ratio. Now, of course, at this stage in neoclassical would object, but I've already kicked them out of the room by talking about endogenous money versus bond. Exogenous money versus bond. Okay. In the real world, private debt matters. Take those three. I'll leave it as an exercise for those who are mathematically inclined in the room, but if you differentiate those with respect to time, you get three truisms. So at this stage, I'm not talking about a model, I'm talking about true statements which are true by definition, but now expressed in terms of change over time. So the first is the employment rate, which is this one here, will rise if economic growth, real economic growth, exceeds the sum of population and labour productivity growth. That's simply restating that definition in dynamic terms. The second one is the wages share of output will rise if wage rises exceed growth in labour productivity. And the third one, which is fairly obvious, the debt ratio will rise if debt grows faster than GDP. Those are three, it's not yet a model, it's a set of facts. Given the definitions, those are facts. Now you can turn them into a model by postulating extremely simple relationships. The relationships are more complicated. Okay? But the whole point of Lorenz's work was to say you actually get the deep dynamic behaviour of a system by starting with simple definitions and then making them more elaborate later. But let's uncover the really deep relationships first of all. So I'm going to start with a constant relationship between capital and output, which is usually the accelerator relationship. Real output is the real capital stock divided by some scalar value for V, which is normally, when you measure it between 2 and 4 for most economies, tends to average around 3. So the real value of output, however you work it out, will be roughly 1/3 of what you value your capital stock at. I've got a constant ratio of output to labour. Now A itself changes over time, constant at any point in time. Labour productivity in this model grows, but just a simple relationship between the two. So given the level of output and given labour productivity, you work out how many workers you employ. I've got depreciation going on there. So in capital, the rate of change of capital is gross investment minus depreciation. And I've got population and labour productivity both growing at constant rates. So I haven't got any feedback between rate of economic growth and rate of technological change. Of course there is. And it'd be nice to add that in and make the model complicated. I said that as an assignment for my students last semester. And debt, all the debt I assume is just used to build factories. So I don't have any Ponzi behaviour going on here. Okay? So change in debt is investment minus profits. And I've got a linear Phillips curve. So I know that the relationship is non-linear. If you read Phillips' original paper, not only is it non-linear, it has 3 causal factors, not just 1. So it's worth reading Phillips on that front as well. But it's simply starting with a linear Phillips curve for now. And what I add in is a linear gross investment function. So investment is a function of the rate of profit. And past a certain level, firms borrow money to invest more than they have in retained earnings. Below that, they use the extra profits to pay their debt level down. And that in fact has been empirically confirmed by, of all people, Fammer and French. Now you model it, and what you get is a model that has inherent non-linearities in it. Now I apologise for being slightly scary here, for those who aren't used to equations. I know some people think that's pretty scary. In fact, it's relatively simple. There's three variables. Lambda is the employment ratio, omega is the wages share of GDP, and D is the debt ratio. So there's only three variables inside there. But what's different about the model is that those three variables are multiplied by each other. So these are inherent non-linearities. I'm not getting non-linearities because I assume non-linear behaviour. I've just shown you I assume linear behaviour in this model. But you get structural non-linearities. This is what's left out of neoclassical thinking. A by being equilibrium and B by linearising around often unstable equilibria as well, as they do around the DSGE model, which is mathematically false behaviour. So the first equation I've got employment times the negative of wages share and the debt ratio. And the second I've got the wages share times the positive of the employment rate. And you've got the negative of debt times the negative of wages and debt share itself. Yeah? They normally, when they have a non-linearity, they do one of two things. They either linearise, so they turn a non-linearity into something linear. For example, you'll assume the wage rate is constant. If you have an assumption at the macro level that wages are constant on the basis of so-called competitive theory, then you turn a variable into a constant. And rather than having two variables multiplied by each other, you get one constant times a variable. You're back to a linear model. Or what they will also do, and this applies to those DSGE models that they were once so fond of. DSGE models, dynamic stochastic general equilibrium models, are derived by taking what's called Ramsey's growth model from 1925. And Ramsey's growth model was asking what is the ideal savings rate for an economy. And he had the ideal savings rate talking about both maximising utility over time and being as efficient in production over time as possible, and had two equations to it, one of which was capital output ratio, the other was a marginal utility derived equation. And he was unhappy to find that the model, the equilibria, this future equilibria, what he called a bliss point, was mathematically unstable. It was what's called a saddle. A saddle. If you imagine there's three possible shapes for a two-dimensional system in terms of its stability. I wish I had has anybody got a hat? I can't see any hats about. Okay. If I had the cone that you'll see Vietnamese farmers have, that'll do. Yeah. Okay. That way around it's stable. Okay. That way around it's unstable. The shape that the future equilibrium had in Ramsey's model was actually neither of those two. It was like a saddle, a horse's saddle. If I drop a ball bearing in that hat, it'll end up down here. If I drop a ball bearing here, it'll roll off. What if I try to land a ball bearing on a saddle? Will I be able to? Oh yes, well that means you're not rational. What they assumed was, first of all, in Ramsey's paper, he assumed there was a social planner who could work out that equilibrium. And then his role was to work out how much you had to change consumption or investment today to get onto the stable path so you'd end up on this peak of the saddle in the future. Now that's pretty crazy. The social planner would have to say, I'm sorry, you can't consume that much, you've got to either consume more or less now, because only one particular trajectory will get us onto this saddle point in the future. And the neoclassical model said, oh, we're all that intelligent as that central planner, so we can work out where the saddle is, and if the saddle moves because of a shock, the fictional shocks that Rome was talking about, a shock to preferences or technology, we can work out where to jump to now to get to that equilibrium path, unstable equilibrium path to converge there. This is a disaster from a mathematician's point of view. That's why I say what they call mathematics in neoclassical economics, I actually describe as mythematics. It's a bunch of myths supported by mathematical argument. Whose hat was this? Go this way? Okay, coming back. Whoa! Okay. So that's what they do. What I said, let's just take this model and see what its behaviour is. Now, what is this behaviour? Well, this is a model I discovered in 1992, by the way. I did it with non-linear functions back then. I wish I'd done it as I'm now doing with linear first and non-linear later, but I worked straight from non-linear behavioural functions. It actually has two potential states. One is a nice smooth convergence to equilibrium. As you can see, the employment rate is fluctuating heading towards 60% of the population having a job, and the debt ratio is fluctuating towards the debt ratio being 60% of GDP. Just coincidental, they're the same values. So that's the equilibrium. That's a good equilibrium. You've got a positive worker share of GDP, a positive employment rate, and finite debt level. Now, with a slightly higher level of desire to invest by capitalists, that's what you get. You get this period of apparent convergence, diminishing cycles in employment, but then they start to expand again. That cannot happen in a linear model. That type of dynamics cannot occur in a model which is linear. It has to go one direction or the other all the way. Change direction halfway is a sign of a nonlinear system. And the debt level reaches a much higher level and appears to stabilise but then explodes. So that's the model of the crisis we went through. And the difference is just simply how willing capitalists are to invest. So we bring that model up in Minsky. And I simulate it with a low level of a desire to invest by capitalists. Then you get that smooth convergence. And what neoclassicals did, without knowing they were doing it, back in the 1990s and 2000 period, they saw different convergence and thought this is what was happening. We're reaching equilibrium. Trade cycle is over. That's all the euphoric arguments they had about having solved crises and prevented depressions and so on. But if I make capitalists more willing to invest, which you'd think would make things better, then you get this sort of behaviour. Now that's closer to what actually happened. It's unrealistic because it's linear. The behaviour is linear. But that's the sort of behaviour we saw happening back in 2000. They had no idea it was coming their way. So you get cycles to equilibrium with a low level of capitalist desire to invest, and you get a high growth rate out of that, and stable income shares, which is what you'd want capitalism to give you. When you have a higher level of desire to invest by capitalists, you get convergence to a bad equilibrium which has zero wages shares, zero employment, and infinite debt ratio. And there's lower growth before the system actually collapses and rising inequality. Well, that's closer to the world we're actually in, unfortunately, than the previous world. Pardon me. Got a little bug in Minsky there. That's the system crashed at some point. How amazing. Okay, right. Now, if I have a more complicated model, this is a more complicated model. That model was just without a price level to it. And this model I've added prices, which are monetarily determined prices. Okay, starts looking scary. I can actually read you through the logic. That bit here says net investment determines capital stock, which gives you a nominal price for capital and also real output. Real output divided by labour productivity gives you how many workers you employ. Divide that by population, you get the employment rate. Feed that into a wages function, which is here a non-linear function, and you get the rate of change of wages. Integrate that, you've got the wage level. Multiply that by employment, you get the wages bill. Subtract the wage bill and interest from nominal output, and you get nominal profits. Divide that by the capital stock, you get the actual rate of profit. Feed that into an investment function. That gives you the percentage of GDP spent in the investment. That gives you gross investment. And if gross investment exceeds retained nominal profits, you have to borrow money. If you borrow money, you've got to pay interest on it. That comes back up here again. That's the model. Not quite as complicated as it looks, is it? Okay, so it's complicated. But I run that model, and it looks a bit more like what we actually did go through. If I bring up the employment rate here, it appears to cycle down and settle down, then it appears to get more volatile again, and then it finally seems to stabilise, and then suddenly, without warning, it collapses. What's actually been going on that economists have been telling us to ignore is a rising level of debt to GDP. The rising debt to GDP has been achieved because as workers get paid less, more money's gone to the capital, to the bankers. Capitalists one offsets the other, and so far as they're concerned, everything's perfect. But if you keep on going a bit longer, finally debt takes over the entire economy, and capitalists are the last ones to know capitalism is coming to an end. Which again sounds like the real world, doesn't it? So that's the sort of dynamics, and that's only the second stage in developing this model. There's a lot more work to do to make it more realistic, but that's the starting point, and it's describing the system we're in, not some mythical world we wish we were in. So this is the sort of stuff I want to have in economics, and to get it there we've got to get rid of the neoclassical. It's simply wasting our time. It's the wrong stuff to be learning. So a new economics is possible, and by the way, having known that you don't pay fees here, okay, and you actually get a living allowance, that's fantastic. That's how education should be. Education is a social good. It should always be treated that way. In the Anglo-Saxon country, they made it into a private good. Students have to pay outrageous fees. They're trying to make it more and more market-based. And all those procedures have gradually undermined the free time all academics used to get to actually think. And now we're caught up producing pieces of paper for bureaucrats and getting zero funding to do it. And that's eliminating the qualitative side of universities, while students are too busy getting part-time jobs to pay their fees back to actually pay any attention in classes. So the quality of education is declining seriously in the Anglo-Saxon countries. Do not make the same mistake. Any politician suggests fees for university students, barricade his office. Okay? So a modern university unfortunately gets in the way of developing an alternative. For a start, people like myself want to get jobs at low status universities because the neoclassicals have captured all the high status ones. When I turn up to talk at Cambridge and Oxford University, they put out garlic cloves on the doors of the economics building to stop me getting inside. As far as I'm concerned, I'm Nostradamus or whatever. What's it? Nosferatu. I'm Nosferatu. So we only get jobs at places they couldn't be bothered getting a job at anyway. And then those places like Kingston, their viability can be undermined by a simple change in government policy. Now that happened a couple of years ago, and that policy was imposed by people who've done, what they call PhD degrees, philosophy, politics, and economics degrees. They get 1 year of economics, they think they know something. They're learning neoclassical stuff. They think make anything into a market will work better. So what do? They deregulate controls over universities offering positions for different subjects to first-year entrants, to high school leavers. And so those universities offer more humanities places because they're cheap to teach. All you need is one more chair, as opposed to needing an oscilloscope or something complicated in a STEM subject. So our humanities intakes at these lower-ranked universities disappears, and the viability of non-orthodox economics is undermined that way. And it's because school students, you all know for yourselves, you had no idea there was disputes inside economics, did you? Before you got here, you found out the hard way by studying this stuff and thinking there's got to be something wrong here, and thank God there's a critical literature you could look up on the web and find out why. But school students haven't got a clue about that, and you can't tell them. Okay? They're not yet enough engaged in society to actually be told you'll learn better economics at the low-ranked universities. They'll just say, you've got to be, what's that person been smoking? They won't take you seriously. They think the high-prestige universities have to be where they get a better education. Then they get there and they turn into you lot, which is good. I'm glad you're continuing the protest that I began myself as a student 45 years ago. But that's, at the end of this whole process, we're actually winning the war finally. The non-mainstream people like myself are even getting the ears of mainstream people like Olivia Blanchard and Kosha Lakota and so on, and saying, yes, you're right, we made some mistakes, we may have to amend in various ways. But in the meantime, we're being squeezed by the last vestiges of neoliberal policy that have ruined our student intake, undermined the viability of the universities we do teach at. And then, of course, we get trivial research funding in general because, first of all, the vast majority goes to mainstream economists because they're the ones who do the refereeing, and they work at universities that have better internal funding anyway. But otherwise, we're just on the outer. So I've had enough of it. I'm going crowdfunding, and this is the reason why. I actually developed Minsky 2 ways. One, by getting a grant from INET, Institute for New Economic Thinking, to develop the first stage of Minsky. I asked for $250,000 to build a model from the ground up. They gave me $500,000. Sorry, I asked for $250,000, they gave me $1/8 of a million and said do it for $1/8 of a million. Well, I'm sorry. You get a certain way, but not the whole way. Then what happened in the UK now, happened to me in Australia beforehand, deregulating first-year student numbers. That destroyed my department at Western Sydney. I could no longer apply for a research council funding, so I went Kickstarter and I raised the rest of the money to make Minsky as complete as it is today from crowdfunding. But that's not the right vehicle for me to continue doing this indefinitely. So a new website called Patreon has started, and that is people giving as little as $1 a month to support an artist they like. Well, I'm taking art to economics. So I'm going to continue funding myself to do what I'm doing here and doing the research I'm doing as well. Continue developing Minsky. I want to establish an online university to really teach you critical economics and people to understand it properly. That's the ultimate ambition that I've got there. And if you can help out, if you can't, don't bother. I'll do it anyway. But if you can afford as little as $1 a month to help out and keep me doing what I'm doing here, I'd be most appreciative. And you can be contributing a bit both here and globally to making economics finally a realistic discipline. Thank you.